Meta stock just took a sharp hit after earnings dropping, because the company announced it will spend billions more than expected on artificial intelligence. These investments include new data centers, custom AI chips, advanced infrastructure, and tools that Meta believes will power the next decade of growth. But here's the big question. Investors are asking, is this massive AI spending a smart long-term investment? Or is Meta risking profitability and repeating the same mistakes it made with the metaverse? In today's video, we're going to break down exactly why the stock fell, what Meta is building with all this money, and whether this drop is actually reasonable or a complete overreaction from the market. In Meta's earnings call, management explained exactly why the stock dropped, and it comes down to two things: huge AI spending and a one-time tax hit. Meta reported strong top-line growth, with total revenue at $51.2 billion, up 26% year-over-year. Ads revenue reached $50.1 billion, also up 26%. Reality Labs revenue came in at $470 million, up 74% thanks to strong stocking of Quest headsets and high demand for AI glasses. Operating income was $20.5 billion, with a 40% operating margin. But a one-time accounting adjustment related to U.S. tax law pushed Meta's tax rate to 87%. This made net income fall to $2.7 billion, and earnings per share dropped to $1.05. Without that tax hit, EPS would have been about $7.25. Headlines made the results look terrible, but the underlying performance was extremely strong. At the same time, Meta confirmed that it's entering the most expensive investment cycle in company history. CapEx for the quarter was $19.4 billion. Full-year CapEx is now expected to hit $70 to $72 billion, and management said 2026 will be notably larger than 2025. Total expenses rose 32% to $30.7 billion. Headcount climbed to over 78,000, driven mostly by AI engineering, infrastructure, monetization, and Reality Labs roles. Meta also warned that 2026 expense growth will accelerate significantly as AI infrastructure, cloud costs, depreciation, and talent spending ramp up. Mark Zuckerberg explained why this spending is happening. He said Meta is compute-starved, meaning the company doesn't have enough computing power to run all the AI models and products it wants to build. So Meta is aggressively front-loading investment to create industry-leading AI compute capacity, including for future superintelligence. And here's where the fear is actually misplaced. Zuckerberg said that even if Meta accidentally overbuilds, the company can simply slow construction, repurpose the compute internally, or even sell excess compute and AI cloud infrastructure to third-party companies, just like Amazon Web Services, Microsoft Azure, and Google Cloud. In other words, there is no scenario where Meta builds data centers that sit idle. The demand for compute is already higher than Meta's supply, and companies are already approaching Meta asking for access. Despite the heavy costs, Meta delivered huge signs of operational strength. 3.5 billion people use Meta apps every day. Instagram hit 3 billion monthly active users. Threads passed 150 million daily actives and saw a 10% increase in time spent just from ranking improvements. Video time spent on Instagram is up more than 30% year-over-year. Reels hit an annual run rate above $50 billion. Meta AI now has over 1 billion monthly active users, and engagement rises every time the models improve. AI-powered ad tools surpassed a $60 billion annual run rate. WhatsApp paid messaging revenue grew 59%, and click-to-WhatsApp ads grew 60%. The core business is firing on all cylinders. Reality Labs is still dragging on profits, and Meta warned that Q4 revenue for Reality Labs will be lower due to headset timing. Management also mentioned increased regulatory pressure in the US and Europe that could impact revenue. But none of these issues change the fundamental strength of Meta's business. So the story from the call becomes clear. Meta delivered strong revenue, strong engagement, and strong operational performance, but the stock dropped because Meta signaled that AI spending will accelerate sharply in 2026, while a one-time tax charge made earnings look weaker than they actually were. This combination created the perfect setup for a market overreaction. When you look at the full picture, the market's reaction looks emotional, not logical. Yes, Meta is spending heavily, but this spending is not reckless. Zuckerberg explained that all compute they build can be used profitably inside the business, and any excess can literally be sold or leased to other companies as cloud capacity, turning what looks like overspending into a new revenue stream. Meta is not gambling. It's investing in infrastructure that the entire AI industry desperately needs. And this isn't the first time the market doubted Zuckerberg. When Meta poured money into the metaverse and the stock tanked, Zuckerberg quickly shifted into the year of efficiency, tightened spending, and rebuilt margins. Meta pivoted successfully, and the stock ripped higher. Zuckerberg adapts fast when needed. Now he's pivoting again, but this time into AI, a space with far more immediate and proven monetization than the metaverse ever had. AI is already improving ads, recommendations, business messaging, and content creation. It's not hypothetical, it's already driving billions in revenue today. Meta's engagement, revenue, and advertising performance are growing strongly, and AI is expanding that growth even further. With over 1 billion people using Meta AI and a $60 billion ad run rate powered by AI models, the upside is massive. The only thing that spooked investors was the rapid increase in spending, but the fundamentals are stronger than ever. Put it all together, and the dip looks much more like a buying opportunity than a warning sign. Meta is spending heavily on infrastructure that will strengthen its core business, open new revenue streams, and position the company to dominate the next wave of AI computing. With the ability to monetize excess compute like Amazon, Microsoft, and Google, Meta's downside is limited, and the upside is enormous. So, should investors worry? Based on the numbers, the strategy, and Zuckerberg's track record, the answer appears to be no. Meta is still producing massive cash flow, still buying back shares, and still leading the world in consumer-scale AI. The long-term story is intact, and this investment cycle could power the company for the next decade. The market sold first and asked questions later, but the fundamentals didn't break. And that wraps up today's analysis. If you found this breakdown helpful, be sure to hit the like button, subscribe for more deep dive stock content, and let me know in the comments whether you think Meta's drop was justified or if this is just another chance to buy the dip. Thanks for watching, and I'll see you in the next one.